Welcome back. We've had a slew of economic news this week, starting out with the PPI, Producer Price Index, which increased 0.4% month over month, beating estimates of 0.2%, 8.5% year over year, also beating estimates of 8.4%. The core PPI, that excludes food and fuel, increased 0.4% month over month and 5.6% year over year, respectively. Now, the CPI, the Consumer Price Index, rose 0.4% month over month and 8.2% year over year. That also beat estimates on both ends. Retail sales were unchanged. The core retail sales were up just slightly. Business inventories were up just a little amount as well. But the big story certainly this week has been the inflation numbers beating estimates. And as we know, as the inflation numbers indicate that inflation continues to rise, we're now at 40 some odd year highs. That increases the likelihood of the Federal Reserve to continue to raise interest rates, and certainly we can see that impact to the markets. Really briefly, take a look at the streak of positive CPI numbers. Except for maybe two reports ago, we've seen just a continuous move of CPI moves to the upside, continuing to show inflation rising over time. CPI in the white chart below, steady rise to the upside. Advanced retail sales kind of cooling, still near the upper end of its respective range, but not as strong as inflation numbers, to be certain. Business inventories are also continuing to rise ever so slightly. The PPI, the Producer Price Index, the chart doesn't look as good as the CPI, but it's still certainly near the upper end of the range as well. Statistically speaking, we can see the CPI at a new at least 10-month high. We actually know these are the higher highs that we've seen in many decades. But this is also registering an absolutely brand new high. Inflation doesn't look like it's going anywhere but up. Taking a look at the equity markets, on the left-hand side, the top left-hand side, the yellow chart shows us every component of the S&P 500. Every single dot represents one stock in the S&P 500 and their own respective RSI, relative strength index. Now, this is obviously measured on a scale of 0 to 100. The vast majority of these stocks have an RSI between 50 down to, let's say, 25 to 30. So they're weak, but they're not oversold. We're starting to see more stocks cross below the 30 level, and that is technically considered an oversold level, but stocks don't need to stop with an RSI 30. They can go to 20 or 10, but it does show us they're absolutely weak. The right-hand side, the yellow lines show us the pure count of those stocks at a particular RSI level. So we see here the highest histogram bar shows us nearly 120 stocks with an RSI between 40 and 45. Another 110 stocks or so with an RSI between 45 and 50. The vast majority of the market has a relative strength that is trending lower. Now, the green charts show us the same S&P 500 components, but this time in terms of their own respective 52-week range. So imagine every stock is trading between $1 to $100 a share. Well, the vast majority of the stocks in the S&P 500 would be trading around $5, $10, $15, $25 a share. There's a very definite grouping. And then the right-hand side shows us a histogram bar that show us the count of every stock. And the highest histogram bar here shows us 126 stocks that are between the 10 to 15 percentile area of their own 52-week range. So the whole story of this continues to show us stocks are at or very close to the 52-week lows, but the market hasn't really become very strong to the downside yet. It hasn't accelerated lower. We're not seeing very fast moves. When you see the Dow Jones Industrial Average down 1,000 points in one day, for example, that would be indicative of a very fast move. We're not there. I would guess we're going to get there eventually. Markets really need to hit an inflection point before they turn. I don't think we've seen that point yet. Now, we have here a little bit of a custom indicator that we've created. The blue line shows us a housing index, and that's really the combination of the home price index, the sales prices, existing homes, construction, etc. It's pointing lower. It's within its long-term trading range. Nothing big to say here. But the growth index, that's the green line, that's made up of retail sales, which we know were not so great, actually a little bit weak. Industrial production, that was kind of flat. Capacity utilization last week, non-farm payrolls not so good as well. Durable goods, business inventories, manufacturing inventories. Point being is a green line has now returned back to levels we haven't seen since probably July of last year. So we're at maybe even a little bit further back than that. So what this is showing us is that growth is certainly slowing. And if we were to compare this to a few months ago, we have seen a dramatic move. The inflation index, which is comprised of the CPI, the PPI, and also the personal consumption expenditure, the PCE, has pulled off its highs, but definitely the strongest of the three numbers. Housing is the weakest, growth is right in the middle, and then obviously inflation is probably the highest reporting number that we're seeing. Now, high inflation numbers, although they're high on the chart, the effect to our economy is actually quite the opposite. So this is really not something that we want to see. I would say the biggest story of the week in terms of the markets, aside from obviously a big day yesterday to the upside in the stock market and then a return to the downside today, is the bond market. And we're continuing to see a move of capital out of the short-term bonds. We know this because the yields continue to rise. Take a look at the one-year bond, up 0.4% or 4 basis points today. The 2 up slightly, 3, 5, 7, all moving higher. What's not moving as much higher, the 20 and the 30 year. So we see capital is moving out of the short-term bonds, forcing their yields up, and into the longer-term bonds, which is suppressing those yields. So we're continuing to see the same trend continue to take place. Taking a look at this from a bigger picture, top right-hand side, the red line represents all the bond yields. If we were to add the 30-year maturity and the 20-year, all those different yields together, that would show us a steady trend to the upside. Yields just continue to rise over time with very little pause. The blue line shows us the S&P 500. Now, yesterday, the Dow, for example, was up huge. It was up 1,000 points or 800 points and then back down about 400 today. The S&P 500 percentage-wise moved in similar fashion. But we see, and this bounce that we saw yesterday, we looks like we're really close to the lows again. So I wouldn't expect that this is necessarily a bottom unless we really form a strong basing pattern. I don't think that's the case yet. But we're seeing a continuation in bond yields to the upside, which means a continuation in stocks to the downside is logical. It makes sense given the story, which is higher inflation numbers leads to higher Federal Reserve possible rate hikes, and according that will continue to place more weight or pressure on the stock market. In the center, the red line shows us a total bond yield, same chart as before. The green line shows us the spreads. Now that's the difference between the 10-year and the 20-year, the 20-year and the 30-year. The story is that these spreads continue to contract. And now we're seeing actually fresh lows. What this shows us is that, and these lows go at least back to May, and probably the lowest lows we've seen, and this is a custom indicator. I don't know if that you'll see this type of comparison anywhere else. But essentially, what this is showing us is that the difference in interest rates between pairs of similar maturity bonds, like the 20 and the 30 or the 10 and the 20, those continue to get more and more narrow. And that is a result of the inversion in the interest rates and the inversion in the bond yields. So, for example, take a look at the 10-year versus the 1-year. The 10-year bond right here, we pays a 4%, 400%. The 1-year pays 4.5. The 2-year pays 4.48. We haven't seen this much of an inversion so far. We have a 50 basis point, a half of a 1% inversion. You're getting 0.5% more buying a 1-year bond than you are buying a 10-year bond. Last week, this was in the 4s, 0.42, 0.45. It's now accelerated to a 0.50. So I think all of these different indicators sort of tell the same story. The fundamental indicators tell us inflation continues to rise. And that translates into a stronger dollar. It translates into higher total bond yields. It translates into a further compression of interest rates among similar bond maturities, such as the 5 and the 10, the 10 and the 20, etc. And it also shows us that I think we can deduce the expectation of higher interest rates will continue to weigh on stocks. Stocks don't like higher interest rates. It makes it more expensive for investors to borrow money, for investors to take out loans and to invest in new businesses. It makes savings accounts and fixed income products more attractive, and that attracts investment capital away from stock markets and away from other types of investments. So despite yesterday's very big day to the upside, based on everything else we've seen, I would be not surprised to see stocks continue to, over the long term, to trend lower, at least until we hit some sort of an inflection point where we see a VIX, for example, that has registered very, very extreme levels. And we actually put together a pretty interesting video that analyzes the VIX and how we can read that. We'll place a link right here if you're interested as well. We hope this has been helpful. We look forward to seeing you back soon.